Certainly you and Chair Yellen are running a central bank distinct from the challenges that other central banks have. Do you feel going into the September meeting, or for that matter the December meeting, that you are the central bankers to the world, or can you be discreet and look only at the United States economics?
Well, the world is becoming increasingly interconnected, particularly the capital markets of the world. So what we do affects many other countries. That was always so. It's also true that what they do affects us. So we're dealing with interconnectedness, and we are probably the most important of the central banks, but the European Central Bank is operating in an area of about the same level of GDP, and what it does matters a great deal, and so on.
Different economists, Paul Krugman at Princeton and your colleague Olivier Blanchard at MIT, have a primal scream to go back to simpler economic models, to move from the modern mumbo-jumbo back to simpler models, more hooked into the real economy. The debate at Jackson Hole and the debate you're having at the Fed, does it need to go back to simpler models that you taught years ago at MIT?
Well, we'd all love simplicity. The question is, I think, DSGE models, as they're called, those which are fundamentally forward-looking, and the future matters and expectations matter, or those which are more traditional but maybe very big. The basic model that the Fed uses, the so-called FRBUS, FRB-US model, is actually large and quite complicated, but its structure is one that one could explain to economics students.
Well, I would like you to explain it now to bankers, because what I would suggest respectfully, sir, is I saw a lot of economists talking to each other at Jackson Hole. There's a whole other system out there. When we look at negative rates, when we look at tepid subpar economic growth and the productivity that you mentioned, I don't see the economists addressing the dysfunction to the financial system. Within the debate that you're having for September and December, are you sensitive and aware to global finance and global banking having to deal with negative interest rates, just as one example?
Well, we're sensitive to what's going on. One hears about it, one hears and reads about and talks about what's happening.
You just have to look at their stock prices in Europe, sir.
What's happening in Japan, for instance. Yes, we take all that into account. The United States is fortunate that we're not in a position where interest rates are negative or have to be negative. And we're not planning to do anything in that direction. But we certainly follow the debates, and we certainly follow the theory of negative interest rates.
Within negative rates, I spoke to you at the Council on Foreign Relations in New York pretty much when it was starting. And then we had a conversation with you a number of months ago, maybe it was half a year ago, I can't remember now. And here we are today. What have you learned about negative rates in the crucible of the markets? What have you learned in the last number of months?
Well, we've learned that the central banks which are implementing them, there are 4 or 5 of them, basically think they're quite successful and are staying with that approach, possibly with the exception of Japan, although they're thinking it through and they have said they'll come back to try and make negative rates work better. So we're in a world where they seem to work. I think one of the most interesting developments I've seen in theory is a paper that says, yes, they work up to a certain point and then they become counterproductive.